Alright, this is question 8.3. Well, I guess it's a question from Lab 8, question number 3. Question number 4, actually. Sorry. This is Lyrics Lab 8, question number 4, or 353. And it is an equity method question, by which we mean that we buy an investment in another company which we have significant influence over. So that company, Opong Corporation in this case, would be referred to as an associate. And so when the associate earns money, we have to record our share. The tricky thing about this question is when we pay for it, there are some assets which are undervalued, and so the amount of our payment gets allocated to that extra fair value increment from the assets which are undervalued. And some of them are buildings in this case, and so buildings are depreciable over their life, which means that when we paid for the assets as part of our corporate group, we paid more for them than Opong Corporation did, so that we need to deduct the depreciation on those assets, of course adjust for the fact that we're only partial owners of it. So our share of the depreciation needs to get charged against our investment income from that company. Now that will be fleshed out in a lot more detail in Business 401, the Advanced Financial Accounting course, which will be presumably in your future at some point. But at this point, we'll just work through the calculation, and I'll show you how it works. So first of all, we bought an asset. So that asset was bought on the 1st of January. And that asset is an investment. So if we click on assets here, it's useful to kind of look at it here. The investment in associates Opong company shares. We paid $334,000 for those. So that's pretty easy. And when we say paid, we mean cash. So that's gone. And that's the purchase. The next thing that happened is they earned some money. So we get our share of that money. And so at the end of the year, we get their financial statements, and we say, oh, look at that, they made some money. And if they made some money, we get our share, and that increases the amount of the investment in our associates. Because we left the money in there, it must still increase the value of our investment. So the investment in associates is the proportionate share, 25% in our case, of $190,000 of $190,000, which is their income. And you see that right here. Their December 31st, 2015 income was $190,000, and we bought, as it says up a little higher here, 25% of the outstanding shares. Now that is offset by investment income. So if we scan down here a little bit, investment income and loss. This isn't an investment held for trading. This is an equity investment, a significantly influenced investment, and associate. So that is our share of their income. So share of associates income. That's probably enough for us there, if I could spell it. Now also on the 31st of December, we record the fact that we got a dividend. So the dividend gets us cash. It's always nice to receive cash. So that dividend was $40,000, and we get 25% of it. For $10,000 if you like. And of course that gets offset against our investment in the company. So we increase our investment for the income earned by the associate on our behalf, and when they pay us what they owe us because they earned it and we helped them, $10,000, the dividend reduces the investment in associates. Doesn't get recorded as dividend income because this is the equity method. So this is dividend received. We're not done yet because there's one more thing that we have to think about, and this one is a bit complex. So let me boot up a spreadsheet here just so we can see what's going on. Give me a minute to bring it into view here. Alright, so what we did in this case is we paid for our share. Let's do 100% here. And then we paid our share, which is 25%. We paid $334,000 in cash. Now, what we paid for is net identifiable assets. So we record the fair value of those net identifiable assets. And that's essentially what we bought a chunk of. Make that big enough for us to see. So 100% of them are worth $1,056,000. I'm missing a 6 there. Alright, so let's go like that and then get the format thing taken care of. Okay, so 25% of that is $264. And so if we take the difference between them, put a top border on here, that is the amount that gets attributed to goodwill. Because we paid $334,000, we can only identify $264,000 of stuff we paid for. So the difference between them is goodwill, and goodwill is this undefinable, indeterminable, I guess it's not really undefinable. Its definition is essentially what we're willing to pay an extra 70 grand for. So we don't really know what that is. It could be because this company has particularly good management, it has intellectual capital, it has all kinds of other stuff, but we can't actually put our finger on exactly what that $70,000 is worth. But we're willing to pay $334,000 for 25% of the company, and the company is only worth $264,000 for our share. So that goodwill gets recorded. Now we have to analyze the $264,000. And the question says that we've got two things: land. Well, let's start with fair value. The fair value of all our stuff is $1,056,000, as we see up here, and the carrying value of all their stuff is less than that, $720,000 in our case. So if we take the difference between those two, plus that, minus that, that's $336,000. Excuse me. Now part of that is actually explained by the $70,000 of goodwill. So this is the we're going to call it a fair value increment, for lack of a better term, and that's the one we'll actually use in the future course that I've mentioned. So let's get our accounting together here. So 25% of that, 25% of that, so plus 0.25 times that right there is $84,000. And these are the identifiable assets because it is ones that have the fair value of $1,056,000, as we see up there. So this $84,000, it says, is half for land. So land is half, and half is a building, or buildings. Can't remember the exact terms. So if we take half of 84,000, that's land. Land has the advantage that it doesn't actually increase in value. Not quite sure what happened to the zeros there. And the buildings are also half of the 84,000. I'm not quite sure why they're adding a zero, but we'll take it away. Now the thing is about land, land doesn't depreciate. Goodwill also doesn't depreciate. So we don't need to worry about the fact that we paid extra for goodwill and extra for land, because it doesn't affect income. But well, at least not until we sell it, or in the case of goodwill, until it's impaired, or until we sell it. So if the goodwill is demonstrably less valuable, In the future, we do an annual impairment test, and if the value of the goodwill is not maintainable at a higher level, we actually do a valuation of the company to see whether our share is still worth the carrying value plus the goodwill carrying value. Anyway, the buildings are depreciable. So the buildings get depreciated, and the buildings in this case are depreciable over 15 years. So we paid an extra $42,000 for our share of the buildings, which means that when we take our share of the income from the equity investment, we need to deduct the fact that we've got depreciation on our books that the associate company doesn't have on their books. So that gives us the result of 42,000 times 1 over 15, because in this case we have a 15-year life for these assets. So that's basically the logic of how we calculate the adjustment for depreciation. Okay, that somehow my apostrophe has fallen to the ground. All right, keyword. There we go. That's what I'm looking for. Adjustment for depreciation, 2,800. Okay, so now we know how much the depreciation adjustment is. Let's get rid of this, please. Okay, doesn't want to go anywhere. Let's try a different way. There we go. It's gone. Goodbye. And so now we actually are going to decrease the investment for the investment income or loss. Okay, there we go. And it's depreciation expense, so that's bad news, right? It's 2,800. We can actually calculate that amount if you like. It's 0.25 times 1056000 minus 720,000 times 0.5, because only half of that is ours. Or well, yeah, only. Well, no, actually that we've taken care of the portion that's ours, because it's 25% of the fair value increment, which is the 1056 minus the 720 carrying value. So that's stuff that we bought that they don't have on their books yet. So it's increased in value between the time they bought it and when we bought our share of it. And so we're going to add it to our books at the cost or at the fair value at the time we bought it, because we wouldn't have bought it at carrying value. But only half of it, only the building, is depreciable, and it's depreciable at 1/15, 1 year out of 15 years in its entire life. Works out to 2,800, which is what we just calculated on that other spreadsheet. So we pull that over here, and the other part of the adjustment is investment in Opong. There we go. And this is adjustment for depreciation of fair value increment. Alright, so there we go. Now, summing all of this up, in our first year, we bought the investment. We recorded our share of their income as they recorded it. They didn't have enough depreciation because they bought the asset before we did, and so therefore it hadn't depreciated quite as much because the fair value was different when we bought it. So we paid an extra $42,000 for that asset. That extra $42,000 is going to go away over 15 years, and so that's the 2,800. Now it says determine the amount to be reported by Northco as an investment on its balance sheet. Well, that's a little complex. We just add up all the numbers. So 334,000 plus 47,500 minus the dividend we received of 10,000 minus the depreciation we charged ourselves with, 2,800. So the 368,700 is the amount of the investment, and then the investment revenue is going to be 47,500 minus the 2,800 depreciation, so a net of 44,700. And then the amount to be reported among investing activities on this cash flow statement, the only one that's on the cash flow statement, well, first of all, it has to say cash, so this one is definitely a candidate, and we are buying an investment in long-term assets, so that counts as an investing activity. This one down here, the cash, the dividend being received, doesn't actually count as income, because we've already recorded the income in the previous periods. All we're doing is receiving the payment for that. So the only thing we need to put in there is minus 334,000. This dividend, the receipt of the dividend, is like a collection of well, it's dividend income, so it would be part of operating activities as opposed to investing activities. So investing activities is the amount that shows up in the cash flow statement. So given all of that, we're done. So let's see what Lyrics thought. Lyrics likes all those journal entries. Lyrics likes all of our adjustments as well. So that is it. We're done.